Our mission at SD Bullion is clear: the lowest cost gold and silver available online. While we do not have pretty blue boxes, free shipping, 4% credit card fees, or glamorous gold and silver infomercials, SD Bullion has the lowest prices that may save you hundreds on your next order. So before you make your next investment, do the math and join the over 15,000 new customers who have recently made the switch to SD Bullion. Why pay more?
This is the Doc and Eric Dubin with SD Weekly Metals and Markets Wrap. Well, joining us today is our good friend Craig Hemke, Turd Ferguson himself. Great to have you back.
What's up, Doc?
So it's been an interesting last couple of weeks. We have been away from the show for a couple of weeks with the holidays, and then I was down at the Tampa, the Fund Convention, numismatic convention down in Tampa a couple of weeks ago. So a lot's happened here in the markets to start January. Gold and silver, bonds, foreign currencies, quite a bit of volatility. So why don't we start with the markets, precious metals. Get your take here, Craig, to start the show.
Well, it's been a rather interesting start to the year. Hasn't been quite as dynamic as last January, but nonetheless, we haven't been going down either. It's a little frustrating to watch on a daily basis because the whole world keys off of this paper derivative price that's generated on the COMEX in New York. And that whole pricing process, that whole price discovery process, whatever you want to call it, because they're not really discovering a price of gold, they're simply discovering the price of their derivatives. But that's all controlled by computer. Now, there's really no human individual trader input, it seems, anymore. These are high-frequency trading algorithms. It's 90% of the volume on the New York Stock Exchange now, and it's at least that in the gold pit. And you can sit here on a daily basis and watch it trade. Gold is either tracking the dollar-yen inversely on a tick-for-tick basis, or now, since the first of the year, it tracks the S&P on a tick-for-tick basis. It's just mind-boggling and frustrating at the same time. But we're hanging in there. There's not a lot of open interest returning yet. And I don't know, maybe that's because we're finally having an impact. People are finally realizing they're not buying gold at all. They're just buying, paper derivatives when they trade on the COMEX. But there's no real, I'm not sensing any hedge fund or technical buying or anything like that. Open interest isn't really expanding. And so we've come up some, but we certainly haven't exploded higher. At the same time, the cost structures really haven't changed. So I don't think there's a lot of risk to us going lower either. And so we'll just have to see how these markets play out, meaning the stock market, but maybe more importantly, what's going on in China and how that impacts the Chinese yuan and the Japanese yen at the same time. I mean, there's all these different things that are impacting the price of gold that really have nothing to do with the price of gold. But that's where we find ourselves in 2016.
And the commodities currencies are getting hammered as well, particularly the Canadian dollar.
Oh, absolutely. That's kind of, we get all dollar focused, and, because that's what all the banks and the central banks are all, focused upon and keep managing the price and keeping it down is the dollar price. But man, if you live in Canada or Australia or, South Africa or Russia, and the gold's doing exactly what you want it to do. It's going up in those currencies terms and protecting your wealth. It's a hedge against that paper money going down. It's doing exactly what you want it to do if you hold physical metal in any of those places. That ship is going to sail into a U.S. port before too long too. But in the meantime, we have to continue to fight these banks. Anybody can see it on the chart. In an attempt to control sentiment, they can control that by keeping price down. And I think the big fear of the bullion banks is that if sentiment returns and if that sparks Western physical demand, then they're really going to be in a bind because they're having a trouble, it seems like everywhere, trying to meet Eastern physical demand. If all of a sudden there's Western physical demand too, well, then they're really going to be in a pickle, and that may be the beginning of the end. And so they try to keep price down by controlling the amount of trading interest from these funds, from these algos on the exchange, on the COMEX. They do that by making sure price has great difficulty moving through any technical indicators. Anybody can pull up a daily price chart of gold, lay the 100-day moving average on it for the last 6 months, and you'll see 4 separate occasions, including just yesterday, where gold came up and ran into a brick wall at the 100-day moving average and was immediately jammed back down. And the one time it did get through that brick wall in early October, it ran up into late October and was severely capped at the 200-day moving average. And why do they do that? Because they know if price breaks through the 100-day and then the 200-day, then the technical signals that go out to these computer algorithms to buy more gold, it becomes kind of a virtuous cycle, and they can't allow that to happen. And so if you want to see some upside, watch that 100-day moving average for now, because if we can get through there, then we can maybe get a little run again. But it's a daily struggle, no doubt about it. But that's okay. For all of us stackers, the more time we have with prices down, the better off we are.
And it should be said as well, too, because a lot of stackers look at technical analysis and poo-poo it, and that's missing the point. The point is that the vast majority of managed money in the world, 95% or so of what I always call the conventional finance world, operate to a large extent on responding to sentiment and momentum and directional flows and so forth. So the greatest enemy of the central banker trying to preserve the grand Keynesian experiment is a shift in sentiment that suddenly makes all that ocean of money start considering, never mind even actually chasing, precious metals as a safe harbor. They got to kill that immediately. Otherwise, the whole game is up. The entire system today is predicated on confidence, and it would be impossible to maintain all of these all of these plates that the policymakers of our central banks juggle, were it not to see gold and silver kept under wraps.
Yeah, and to your point, on my site, that I've got, I don't even know how many, well over 1,000 subscribers, let's just put it that way. And I don't know how many actually trade anymore. It's nothing like it was 5 years ago. Most people, where they get the value for their $10 a month is just simply by looking at the trading signals that we still talk about and timing their physical purchases that way. Because they figure, God, I get those emails all the time. I don't trade, but you said silver was about to fall again, and so I didn't buy. And I waited to buy, my next 100 ounces of silver until it fell back 50 cents, and you saved me $50. And so it does help, even if you're not a trader, to be paying attention to this stuff.
Yeah, and it's not even just your personal value proposition as someone trying to help people make better investment decisions. I mean, really, the bottom line, in the grandest of contexts, is that this technical analysis stuff is really important in terms of understanding how the powers that be orchestrate the manipulation that they're achieving. It's not necessarily looking at technical analysis from the point of view of trying to actually forecast markets in and of itself. It's bigger than that. And I know I'm going on a tangent and I'm rambling a bit, but I think it's necessary because there are a heck of a lot of people in the stacker community who, upon seeing a chart or hearing the words or discussion about technical analysis, they just simply turn off their brain and miss the bigger point. I mean, there's a bigger context that people need to pay attention to. So I'm going to shut up now and actually let you take this.
To follow up one last thing on that.
Here's the talking stick.
Just one last thing. I had a guy on my site, this is recently, within maybe the last 90 days, said, Turd, what you do is not technical analysis. You do manipulation analysis.
Wonderful.
and the more I thought about it, I thought, that's right. Because if you understand, especially in gold and silver, and I've said this since the beginning in 2010, if you understand that these things are grossly manipulated by the trading desks of the bullion banks, if you understand that, well, then you just have to simply look at it from their perspective and look at where they're going to try to put up their brick walls, like the 100-day moving average. And if you understand that, then you can actually begin to profit from that and time your purchases or even time your trades. So anyway, manipulation analysis is, I think, a better term. Anyway, back to you, Doc. What else do you have for us today?
Well, kind of piggybacking on that discussion here, we can give a quick update on what we're seeing in the physical markets. Demand has picked up substantially over the last 2 to 3 weeks with the emergence of the financial crisis, the early stages of it anyways. Silver Eagles particularly, here in January, the mints only sold 2 allocations, and they've basically sold 5 million coins, I think 4.95 million. Just due to the way the calendar falls, this month. There's really only 3 Mondays of their allocation, so next Monday will be their last one. So really that's the way the calendar falls is the only thing that's going to prevent an all-time January sales record of Silver Eagles. So otherwise we'd be looking at about 6.9 to 7, over 7 million, I guess might be a little bit short. I think the previous record was about 7.5 million ounces back in 2013, but we're probably going to well eclipse both January of 14 and 15 as the number 2 all-time January sales record. And I can read a quote here from the head of the trading desk of one of the largest authorized purchasers from the U.S. Mint. The whole market this week was kind of shocked at the size of the allocations, with the U.S. Mint shut down for about 4 to 6 weeks. The market expected to have quite a few more Silver Eagles produced and available for purchase. And kind of my thoughts are it's not too surprising that in the midst of financial market chaos that, oh boy, suddenly we don't have as many coins as everyone expected. It's kind of been the Mint's MO, it seems like anyways, in the past. But anyways, the head of one of the largest AP's trade desk advised that the allocation from the U.S. Mint, which we received today, was smaller than expected. I believe it's now likely that the Mint will stay in allocation for Silver Eagles for the foreseeable future, perhaps throughout the entire quarter. And I mean,
Wow.
For what we're seeing, it certainly seems that way. I mean, the very first Silver Eagles are not in yet. I think in the next week or so, we're expecting to get them in. So the first Silver Eagles haven't even hit dealer shelves yet, and the APs are already sold out through mid-February now of expected allocations.
Wow.
Have you seen any shifts in premiums as a result? Or like the first smoke signals of something like that happening not too distant future ahead?
Premiums are high and holding that way. I mean, we're not what we saw back in September of $5 an ounce. Wholesale premiums are
Sure.
around, depending on the AP, anywhere from $2.50, $2.70 to about $3 an ounce. They've maybe eased off a dime or two from the very beginning, but typically once the first coins are in, they drop about 75 cents, and we're not seeing that they're staying elevated. So, I mean, we're certainly not seeing the type of shortage that we saw back in January, but, I mean, the demand is substantial for silver, gold, even platinum. I mean, the platinum maples became available today, and the largest AP sold out of platinum maples in 10 minutes.
Wow.
We know it's really interesting that the Perth Mint plug factored 11 plus million ounces for the American market and beyond when they started exporting last year in a stepped up fashion when Silver Eagles weren't available or readily available as demand required. And are we seeing something similar with the Australian Philharmonics now? Are they stepping up their production? And it seems that way. I'm curious if you think so.
Not to the extent. I don't think to the extent that the Perth Mint did. And you're exactly right, Eric. That Perth Mint dumping into the market is what reversed the premium surge in Western markets. I mean, really, pretty much to the day, the premiums were exploding higher, and Perth Mint made. I think there's 4 million coins sold in a day, which is about 4 weeks worth of U.S. Mint Silver Eagle allocation. So basically, they sold a whole month's worth of Silver Eagle volume.
The
into the market
kangaroos
in a day.
were flooding the market.
Right, which provided investors an alternative because when Silver Eagles aren't available, and I mean at the time they weren't available for under. They're about $6 to $7 an ounce if you weren't buying a monster box. So from there, you're going to turn to 90%. You're going to turn to generic rounds, bars, 10-ounce bars, 100-ounce bars. And so it was just a ripple cascading effect throughout the entire market. So certainly the Perth Mint's, 10 or 11 million ounces, however much it was. As you look back, it's pretty clear to see that was the trigger that kind of reversed the exponential increase in premiums. And without that, I think my original call would have been right. We would have been looking at 2008 style premiums. We weren't really too far from that. So the good news for stackers and investors is right now that gold and silver prices, silver particularly, are back within spitting distance of those lows that we saw back in September. And premiums have come down quite a bit, so it's a much more opportune time to add to your physical stack.
It's interesting. With silver's action in this week, we can even see what I consider to be a representation of this underlying strong physical demand. Certainly, the powers that be can manipulate and push things down at any given moment in time. But when you see snapbacks like what we just witnessed in the last 48 hours, even though the initial push down is associated with what we see in the stock markets, or Draghi coming out and basically repeating the message that he will do whatever it takes to save the system, and signaling that March is going to have more aggressive, asset purchases and so forth. All of that happening in the context, and yet silver is still something that they're not able to push down and stay down below 14 speaks volumes of the underlying physical constraint on the ability of the cartel to manipulate the markets. And with that, I'd love to get your take, Craig, as far as where you see silver in the context of the day-to-day trading that we've been witnessing this week.
Well, you're wise to point that out, Eric, especially in the face of copper, which has now declined under $2, and obviously crude oil is down to 27, 28, and silver's hung in there. And the 14 number is significant. That's where we bottomed at a kind of almost a panic overnight rage sell-off on November 30th of 2014. Okay, so 14 has been a significant level for 13 months now, 14 months. Yep. And we've come down here and have banged around and been shoved below there on multiple occasions. And it's a tired adage. We've used it lots of times, but it really is that kind of pushing on a spring kind of thing. That it doesn't seem to want to be compressed any further. And if anybody wants to pull up a daily chart of silver and just look at the last 2 months, the two important levels are the 50-day moving average, which has now come down to about 1408, but also 1440 is a very significant level technically. And over the last 2 months, we've either come up and tapped or briefly exceeded 1440, or that 50-day moving average on about 5 or 6 occasions, and immediately on all 5 or 6, we have been shoved down lower the next day. I mean, there's a lot of energy. I mean, pull up a candlestick chart of this. You'll see, I mean, it's breathtaking to look at, because just when silver seems to be getting some momentum, I mean, the kitchen sink is thrown at it. What's interesting, though, is with each successive smashback, they're having less and less success. And there is a lot of energy being expended to try to hold it back, to try to keep the downtrend going. And so I think there's a lot of potential here for silver to finally round the corner. I mean, we've talked about, I remember talking with you guys 2 years ago, thinking, okay, we're down here at 18, and I think by, this year we're going to make a move back up toward 22. And now here we are, 14. And so it's not like, hey, we finally got to bottom. But I do think looking at it and looking at that action, and what is almost I don't want to call it a desperation, but certainly a tremendous amount of effort being made to keep trying to shove it back. It's almost like trying to hold back the tide, and it seems to be failing. And so, again, for anybody listening, I would watch the 50-day in silver very closely. It's around 1408. But from there, that 1440 level is significant. And if we can close above there for a couple of days, could easily run all the way up to about 1540 or 1550 before. And I should add, we've had in the last 12 months, went back and counted, I think at least 4 really sharp, really quick 10% moves in silver. Some would say they're just little bear market rallies. And if that's the case, often bear market rallies are very sharp and very quick. Well, those 10% moves have come, like I said, on 4 separate occasions. A 10% move again from here would take us back up to 1550. So it could happen very quickly. No one should be surprised if it does. But the real battle will be then what happens next, and whether silver can continue higher or whether it'll just be shoved lower again by the banks. Yeah,
and just to put a exclamation point on a point you were making earlier, I actually did pull up the chart for silver to be able to speak to this for our audio-only listeners. And in the month of January, literally every time silver has exceeded the 50-day moving average, there were 3 times, including yesterday, silver was attacked.
It's a joke. And I mean, you try showing that chart to some of the apologists and the shills, and they'll try to say, well, traders just don't want to have they're just not desirous to break it through there. Yeah, right. No, that's not how it works. It's this little puny little market that's controlled by the bullion banks or a bullion bank trading desk. They hold all the cards, and they're able to basically do whatever they want. Every once in a while, they get swamped and overrun by some bullish sentiment from some hedge funds or a short squeeze like what we just talked about, and they have to fall back to a higher position. But it's not by coincidence or accident. That's by design.
Yeah, and silver is the most important market to manipulate, to be able to execute manipulation across the board in all other markets.
It's about the easiest one. Yeah, it's about the easiest one too, because it's so small.
That's right.
And it's a joke. Like I said, when we were talking earlier about discovering the value of, or the price of the derivative contract is really all they're doing. There's no delivery associated with the COMEX. That's all just a scam. It's a circle jerk where one bank will take alleged delivery one delivery month, and then they took it, say, from Scotia, and then the next 2 months later, that same bank that took delivery will issue it back out to Scotia. And nothing ever changes hands. And these apologists will sit there and say, well, there's warehouse receipts, and you're too stupid to understand how this works. Okay, so, all right, fine. You can look at the gold stocks numbers for JP Morgan for December. JP Morgan stopped about 98% of the 2,000 some odd contracts of gold that were allegedly issued, okay? It's 202,000 ounces or something. But if you look at the gold stocks report, and I track them every single day, from the 1st of December to December 31st, there were no changes to JP Morgan's vault, none. So they took delivery, if you're going to say, okay, no, but they took delivery, dummy. They took delivery of warehouse receipts. That's all they took delivery of. They didn't take delivery of any gold. They took delivery of a piece of paper. And so again, if there's no actual physical delivery changing hands, I contend you to there's no price discovery that's been made. The only price discovery that's been made is the value of the derivative. That's all.
The original conceptualization of futures markets were such that the underlying commodity had to represent 10% of the overall paper transactional volume in any given month. I mean, that's really where
and that's rational. I'll give you that. That's fine. And that works for me.
And now we live in this bastardized system where the level of leverage in COMEX and LBMA is just mind-boggling. I mean, it was only like 5-6 years ago that we were typically seeing the registered leverage eligible and ratios in the neighborhood of 50-1, and now we're in excess of 300-1 on the COMEX.
Right, and we talk about the flows, okay, and the banks that ostensibly make markets, they just simply issue new contracts whenever demand shows up from the whomever to buy an exposure to gold on the COMEX. They don't actually put gold, they don't move gold into the vault and then lever it 10-1. The gold in the vault never changes. It goes down. They just simply create new contracts regardless.
Your illustration using the stock market and the issuance of new shares to dilute traders is a really great way of explaining it to people. Why don't you walk people through that?
Well, again, on a stock market, on any given day, there's a certain amount of shares for sale or, to purchase. Companies can always do secondary offerings, and they might have, treasury stock and all that kind of stuff of extra shares laying around. But on any given day, there's, X amount of shares in the float, if you will. And so some news item
and float, just let me put you on pause just for a second. I apologize.
Sure.
For people who aren't, daily traders and so forth, float means the amount of shares that are available and freely trading, within a given period of time, like a month or so, as opposed to the treasury stock in the corporation, and as opposed to strong hands or what have you. It's the owners, the managers, so forth. The float is what is the shares that are moving around and parts of the process of the price discovery mechanism. And when you target the float, you can change the price discovery mechanism.
Exactly. And you can sit there and say good news comes out. Apple, suddenly has cured cancer. Okay, I'm mixing my products a little bit. But, why the hell wouldn't they at this point cure cancer? Mm-hmm. They do everything else. So all of a sudden, your company that has the good news, there's more buyers than sellers of this fixed amount, basically finite amount of shares at 9:30 in the morning on the New York Stock Exchange. And so therefore, price has to reach this new equilibrium where willing sellers of the existing shares materialize, right?
Yeah.
So you got all these buyers.
Point. You don't have to act, and Apple I think they're still the largest market capitalized company in the entire world in terms of their valuation. So there's a heck of a lot of quote-unquote stock underneath that beast. But it's only a small portion, the float, quote-unquote, that's actually relevant if one were to try to manipulate Apple. That's the take-home point that people really need to understand. That's why it's so easy to manipulate silver. It's tiny. Yeah. The market is so tiny.
And so when there is demand, the difference in the precious metals markets is that whenever there is demand for futures contracts where buyers show up, they don't just simply buy the existing contracts that were there the day before. All of a sudden, the new buying demand shows up, and the banks just simply issue brand new contracts out of thin air with no gold behind them to meet that demand. And that's why gold never moves 10% in one day. That's why you're lucky to get 1% in a day.
And they can completely hide the tracks as well, too, because if they execute it in the middle of a COT reporting week, and never mind the question is whether or not the data that the banks that are doing these trades providing the COT with, or this CME, the data that is in the COT reports, whether or not it's legit or not, is an open question. Right. But the reality is, even if it is legitimate, they have the ability to completely hide their tracks, because if they time these trades right, no one's going to notice,
right,
other than price signals or the ramifications you see in the marketplace. And then when we point them out, everyone says, you guys are
cares. Exactly. Right. Nobody cares anyway. I mean, I can sit there and I could write up a whole report, and we could just do this exhaustive study, an autopsy of what happened in October when price broke out, and shot through the 100-day, and all this open interest came in, and the banks, all they did was issue all these new contracts. And the large speculators went from a net position about 50,000 long to 160,000 long. And the banks went from a net position of 50,000 shorts to 160,000 short. And they just keep providing the paper as long as it takes to stall the momentum, soak up all of the buying interest. Then all of a sudden they tip the thing over. You get some what's construed to be bad news. In this case, it was the FOMC meeting at the end of October. And then all those specs that paraded and crowded into the gold futures market go parading right back out. And they sell all these longs that they just bought. The banks buy back all of the shorts at the same time, on the other side of the trade. And you get back to this nowhere point like we were finally in December again. I mean, to call it the classic shampoo bottle, wash, rinse, repeat. I mean, that's exactly what it is. Yeah. And until the system changes, it's what we have to deal with. And again, that is why, they are fighting so hard to keep this downtrending tack for the last 3 years. That's why these brick walls are being thrown up at these key technical points. Because if price were to break out, you get this virtuous cycle of upward momentum. And here in the West, we don't want to buy anything that's going down. That no good. We only want to buy stuff that's going up. And if there's a crisis again like 2008 and gold is rallying, you're going to get this tremendous, you think the increase in premiums and the demand that we're seeing for physical gold and silver back in October was something. Wait until, that doubles or triples. And then all of a sudden now the banks are really in a jam because they're barely able to meet Eastern demand through the flow of metal, the exports from the U.S., the exports through the U.K. But if all of a sudden Western demand returns, if all of a sudden they got to put gold back into the GLD, those 800 metric tons that have been taken out,
yep,
where the hell are they going to get it? And so, we're set up for a very interesting year. And, if the stock market and what's going on in China may hold the key, and we're trying to keep real close tabs on that too, because all of these things are connected.
Well, it's a perfect segue. What's your take as far as macroeconomic conditions and this whole deflationary wave that is kind of sweeping over the ability of the powers that be to control it? And where you see things going?
Well, I think my friend Denver Dave Kranzler's got it nailed. We were talking last week, and he said, I think this is why this is working this way. Because you get all these idiots on TV, these talking heads that say, well, China is just a little tiny part of our economy, so why is our stock market going down? It doesn't make any sense. And they're utterly clueless. I saw George Will and Charles Krauthammer talking about this, and I just thought, these guys don't know anything about this stuff. They would invite me on to Fox News to talk about politics, but they let these guys talk about the gold market and the stock market. It's ridiculous. Well, anyway, I think Dave's got it figured out. As China devalues Yuan, you're getting this kind of capital flight from there. And I think what Dave says, and I think he's right, is that there's a yen-yuan carry trade that's been in place for a couple of years. where the yen is sold and yuans are bought, and the Chinese stock market goes up, to keep it as simple as possible. Well, now that that's all unraveling, stocks are going down, yuan are being sold, and yen are being bought back as that's being unraveled. And you've seen the yen move significantly in the last month, but really even since the first of the year. And as we mentioned earlier, all of these HFT algos that drive the U.S. stock market, one of the key drivers, if not the key driver, is the dollar yen. And as the yen appreciates, that USD JPY is what the symbol is, dollar yen goes down. And you can cook up a chart anytime you want. I just tweeted one out today of the last week. I mean, the stock market follows the dollar yen tick for tick. And so that's how it all works. So China is devaluing their currency. Their economy is breaking down. That's causing the yen to go up. And when the yen goes up, our stock market goes down.
Yeah, and all those flows happen regardless of the fact that the Chinese domestic stock market is largely driven by, the crazed speculators in China's culture. It is mostly domestic market, but it hooks up with these international monetary flows that, in fact, move the world markets.
And so you could go on and explain
dynamics
that.
are operative.
Call up George Will and try to explain that to that idiot.
Right.
Because that's what's happening. Okay, so now if you believe, as I do, and you read these things on Zero Hedge, that China has no choice but to continue to devalue the yuan on an increasing basis all year, then that is going to continue to drive the yen higher, and then that dollar yen lower. And it is that the rising dollar yen, the weakening yen, that is what has driven gold and all commodities lower for the last 3.5 years. So this is the key to snapping this whole trend. And that's where the whole thing kind of is being held together with chewing gum and baling wire at this point. And that's why I think this is such a consequential year. And that's why I think the stock market's going down as well, notwithstanding everything that's going on with Deutsche Bank and Glenrun and all the other derivatives that are out there that can blow up at a moment's notice. And this is a tenuous situation. You guys remember, we talked about the stock market rolling over back in August and how the monthly chart was showing us that it was. And if we got a rally after August, then that would just simply be a repeat of what happened in 2000 and 2008. And it's exactly what happened. And now we're just waiting for the last piece of the puzzle, which is the 6-month S&P moving average to cross bearishly through the 24-month. And if we close this month of January below 1920 on the S&P, then that will be exactly what has happened. It'll be the last piece of the puzzle. The door will be slammed shut. The nails will be pounded in the coffin, whatever metaphor you want to say. And the stock market's going down. And if the stock market's going down and the yen is rallying and you got derivative crises everywhere, gold, they're just not going to be able to hold gold back. And you're going to get this rally in gold. You're going to get, again, with the stock market going down, a huge demand for physical gold. And as we've said this whole call, that is what is going to break the bank, the bullion bank, if you will. And that's why I think this is going to be such a, really, really interesting year. And if you've got the opportunity right now to, I know it's a tired story, just keep backing up the truck and adding to your stack. But seriously, later this year, next year, the idea that you'll be able to continue to buy an ounce of gold for 1,100 Federal Reserve notes, I don't think so. You should be, especially if you haven't bought any gold or silver yet. Now's the time. This is going to be some kind of year, this 2016.
Yeah, and really the bottom line, we're talking about wealth insurance and just insurance in general. And having a place in one's portfolio for precious metals is really just common sense. And that used to be normal. And the cultural propaganda from the financial community and beyond, and just in general culture, has just gotten us to the point where Mark Dice can't even buy a single taco with a Krugerrand. It's just that insane.
Right. Or would you rather have this silver bar or a chocolate bar?
And folks, never mind talking and listening to people like Church Ferguson, Doc, myself, whatever. If you just look at what some of the bankers themselves have been saying lately, it's just mind-boggling.
Yeah,
we've had William White, who was the former chief economist for the Bank of International Settlements, come out recently and start talking as far as the gold market having been rigged. He made a statement to that effect many years ago. The data had documented, and now he's talking about how we might actually need a scenario where debt jubilee and other radical solutions are necessary, given the state at which the central bankers and our monetary system have basically screwed everything up. In a roundabout way, this is an admission by people at the very top that they recognize that they have screwed everything up and that radical changes are going to be necessary to fix things. And we've gone through these bubble crash cycles over and over again. March 2000, NASDAQ peaks. 2002, we get the seeds of the reboot from the real estate bubble that was blown and well underway, and then here we are again. They're going to try to figure out how to actually fix this latest bubble that they have blown. Where, as another example, former Fed governor in Dallas, help me out, I'm forgetting his name.
Fisher.
Thank you. Had said in December that we borrowed demand from the future and tried to use the wealth effect to push up asset prices to reboot the economy. I mean, in essence, in normal everyday parlance, in average person's language, that's what the translation was of the statements that he made in the public. And he basically outed the Federal Reserve's policy as being ridiculous. I mean, he's always been more of an Austrian in his thinking, not necessarily like a Keynesian in lockstep with Janet Yellen when he was in the organization itself. But folks, all you have to do is look around and see what people who are no longer actually sitting in the chairs, positions of power, and beholden to the organizations that they have to, follow in lockstep with to see what really is going on. Bernanke has been saying truth. Greenspan's trying to reboot his reputation by speaking that gold is something that people should own. How many people? Greenspan understands what's going on, and anyone who has read his 1967 essay "Gold and Economic Freedom" knows that that guy, in his formal capacity as chairman of the Federal Reserve, was just acting. He was a puppet.
Well, I'll tell you, if I could add one last thing before we go, too. Besides, I've been shouting this now since August. Okay, I didn't just come to the conclusion a week ago when the stock market started going down. Anybody can pull up a monthly chart of the S&P. There, you can go find these things all over the internet, and you can see the similarities between present day, 2008, and 2000 and 2001. And that's what caught my eye in August. And the back of this current bull market was broken in August with a move that was almost identical to December 2000 and January 2008. The rally that we got last fall was almost identical to the rally in January 2001 and March through May of 2008. Mm-hmm. And now we are breaking down. If we fall 50% again, like we fell in 2001 and in 2008, we're talking S&P 1100. We're talking Dow 9,000. Okay, so anybody that's listening to this, if you got a 401k, you got mutual funds in your IRA, now is not the time to be sitting there watching CNBC, having them do all the cheerleading and convincing yourself that everything is just fine. It's not fine. And I'll give you one more warning. Please watch. You're going to follow one stock. Follow the stock of Deutsche Bank. At TFMetals report, we call it Deutsche Bank. They are one of the evil, nasty, global, too big to fail banks. They are the biggest bank in Germany. I think they're the biggest bank on the continent of Europe. They are at all-time lows. The stock price of Deutsche Bank is just barely above 18 today, below the lows that it saw during the financial crisis, down from 30 just a couple of months ago. And I believe, and a lot of folks like me that I talk to believe, that they are the linchpin of the global derivative market. When you hear about trillions and quadrillions of derivatives, that Deutsche Bank is the main player in this, or one of them. And I think actually, when it comes to commodities, they are the bag holder. If you remember back to the financial crisis in 2008, it was AIG who was gladly, they were AAA rated. AIG is the greatest insurance company in the world. And they were gladly issuing all these credit default swaps to anybody that wanted to buy one. at just pennies on the dollar thinking, well, this is free money because nothing's ever going to go wrong. And it was AIG that went straight down into the toilet and almost brought down everything. But they were the bag holder. They were the other party on the side of all those credit default swaps. Well, I think Deutsche Bank is the other side. They are the counterparty to all these commodity derivatives, or not all of them, but a significant portion of them. If all of this continues, the commodity markets continue to melt down with a rising yen and everything that's going on in China and the emerging markets, and if Deutsche Bank goes belly up or close to it, you could bring down everything again in a repeat of 2008, just like when Lehman and Bear Stearns and AIG went down. So with that, I get off my high horse. But look, if you got stocks, this is not the time to just sit there with your fingers crossed, whistling Dixie. Now is the time to be very, very cautious. And if you want to watch one thing that should be your bellwether, flag waving thing to really set off your alarm bells, watch symbol DB, Deutsche Bank. And then go buy yourself some gold. How's that, Doc? We'll kind of segue back out to you, Doc.
I thought you were going to say, and then go get yourself a beverage to enjoy the show.
Yeah, then go get a beverage
that
to enjoy
popcorn.
the show.
This period reminds me a lot of 2000, and it's interesting that you mention that. Former chapter in my life, I was Microsoft's technology analyst managing the TechStalker portfolio and had millions of people following me. So day in and day out, it was like living in a barometer experience where the sentiment of what was going on in that mega bull market of the NASDAQ was just all around me. And I kid you not, March 2000 feels, I felt the same way in March 2000 as the way August of 2015 feels. In terms of the timeline of where we are with our development of the market and so forth, and how sentiment evolves and people wake up, it really was only until about December of 2000 that people began to look around and go, holy crap, the market is in a huge bear market. And all the time leading up to December, people were in complete denial.
Yeah.
And I think that's where we are. We are in that period of denial. We are in that, or literally at this stage, I think we've just gotten to the point where enough of the turmoil that we've seen in the markets around the world and the envelope of geopolitics and political risk that wraps around that has gotten so insane that the conventional finance world, as I like to call them, are beginning to wake up. Yep. And that's going to create some enormous turmoil in 2016. So buckle up, folks.
I can't wait to see where we are when we talk again, guys.
Yeah.
Be back sooner before everything's completely changed.
Well, the internet's still
These
on.
Patterns are, in terms of psychology, are ones that repeat. History echoes through time. Yep. It rhymes.
No doubt about it.
All right. Turd, always great to have you back on the show. It's been a while. Don't be a stranger.
Please, by all means, just let me know whenever you want to talk. And I just can't encourage people strong enough. There's always, hopefully, going to be time to buy gold and silver. We'll see the warning signs before everybody else, right? Because we're all paying attention. But now is not the time to be complacent with, if you want to call it, your regular investments. So please be paying attention and don't see what's the old saw, your 401k become a 201k. Don't let it happen again.
And for listeners who aren't familiar with Craig's regular work, you can check him out at TFMetalsReport.com. All right, so we'll wrap this week's show there. So for the Doc, Turd, and Eric Dubin, thanks for tuning in to this week's SD Weekly Metals and Markets.